Today we're going to talk about peak formations and 3 levels of rise and fall. Stay tuned, traders. We'll be right back. G'day traders, I'm Stacey Burke from Stacey Burke Trading. Today we're going to continue our discussion in breaking down our simple concepts and our simple approach to the markets. But as you can see, as you peel each layer back, there's a whole nother world inside of each one of those layers. And the number one thing I can encourage you to do is to step back and become an observer of the market behavior. One of the things we're going to talk about today is peak formations and 3 levels of rise or fall. Now, I've received a ton of emails, and I appreciate all the feedback. I've got a lot of questions. I'm going to try and get through each of those questions as we progress through each video. One of the most common questions is, can you go over 3 levels of rise and fall? Now, we've highlighted the importance of the high and the low. Now, if you've been following me, number one, if you've been following me, you know that this 12 candle rule has produced a 50 pip movement every single day since we've started redoing these videos. Now, I'm not saying that every single one of those days has been tradable based on where you may be at with your knowledge of this and the material. But there's 2 important concepts I want you to grasp. One is that we're not trying to trade every single move in the market. We're trying to highlight some particular behaviors and be able to identify when there's a high possibility opportunity for us to enter into the market, to position ourselves with a tight stop, a 1-bar stop. I'm going to tell you what, on the 15-minute charts, okay, we'll just go 15 min for now. Your stop should never be bigger than 1 bar. 20 pips max probably, unless you've chased a trade or gotten a poor fill. We're going to talk about that as well, how the market will trap you at the bottom of a 25 pip box or near the top of a 25 pip box, forcing you to take a price high, to buy high or buy low. And sometimes there are times when that's appropriate, a shift candle, and there's times when they're trapping you in the wrong direction, or they're trapping you in a trading range merely to stop you out with the maximum amount of risk. So if you're taking more than 1 candle as your stop, you need to remember the fact that if you're wrong and you lift your stop, or you don't have a stop, that you could potentially be in a measured move, which can go maybe 50 or more pips, depending on where you're at in this weekly cycle. So, okay, you know, the basic template, you know, we open, the market paints a low, paints a high, and goes into consolidation. The same thing applies for a down day. You know, whether you draw a candle, a bar chart, you know, this can transfer to however we want to do it. I'll do this the other way. You know, candles, however you draw them, it doesn't matter. At the end of the day, the week paints a similar, you know, there's going to be 2 types of scenarios. You're going to have an up day or week. You're going to have a down day or week, or you're going to have possibly a doji. Those are the usually three main options that a market will create. Now, the same thing happens each day. The same thing happens each week, on a monthly cycle, whatever. But what will happen typically is the week will open on a Monday, Friday, Monday. The market may move lower, take out Friday's low, or it may already be coming down. It may shift, and it may create 3 levels of rise and fall before it goes into consolidation. Now, within this, we may have 3 pushes to a high before it drops, and gives us 3 pushes down before it shifts within that Asian box. Now, today I'm going to focus a bit more on the weekly patterns, Monday through Friday, because we're going to go through some examples to give you an idea, number one, to step back and be working from the high and the low, and why that's important. So, for example, the market may have brought us up high Thursday, Friday. Monday we open underneath of that, and the market pushes up, pushes up, pushes up, and drops. The easiest way for me to track this is I call Monday day one. To me, that's very straightforward. But if you're inside of a peak formation from the previous week, okay, we want to identify what I call anchor points. The anchor point low and the anchor point high. This gives us a reference point when we get to day one of where we're at, perhaps within that bigger box. So what's important about this, though, is that a lot of traders will automatically assume that that's day one, and we may have a low somewhere in here that's happened from Friday, that the market may drag traders down lower, trapping them into a downward move before pushing back up to that original high. So Monday and heading into Tuesday now, we may have day two. We may be day two at a high. Instead of thinking that traders were looking to short this back on Tuesday, back with the trend down, and they get caught for the move back up to the high. The market will come back into consolidation, and it may start working lower before shifting up, and again work itself into this high area, which again most likely will correlate with double zeros or 50s in most cases. The typical behavior that you'll see on a day three or a level three, whether it's intraday, interweek, monthly, on the daily chart, or over the course of weeks, is that on that third level you'll often see a 1, 2, 3 push to the high within that daily cycle. So if we called this day 1, day 2, day 3, and we said that's Wednesday, we may be pushing into a high, creating a new peak formation before the market shifts. And there's a concept I want you to focus on here. The last low before the high. Okay? So if you can identify the last low before the high, and then the market shifts, which again we talked about this, it's not uncommon to see that on the Fed days, possibly even the BOE. But when we see that shift and then come back, we see stops get hit on the top and on the bottom of that day. The market will often work underneath of that peak formation and sometimes go sideways into day 4. So in this case, we'll call this a Thursday. Now this could be a Friday, Monday, Tuesday, but typically when I start Monday, I think Monday day 1, Tuesday day 2, Wednesday day 3. And on this day underneath of the peak formation, there's two options. We'll see the market consolidate and possibly go into a tight range and possibly reverse out of there quite strongly, and we'll go through a few examples of that in a minute. Or we could see it pull a reset, what's called a reset, where it will pull down and then shift back and go back towards the high of the week, which we will also see. And then again on day 5, Friday, the Friday reversal, we can often see Friday reverse off of that peak formation if the market is jamming into a level, or if it's had a reset, to continue that move for a second day trade. Now generally, just erase this. Generally speaking, sorry about the mess. Again, day 1, day 2, day 3, day 4, day 5. Each week will always paint a new cycle. You might see the market drag traders down and then move up strongly, only to come back and hit it again on Tuesday or Wednesday. Hit it again on the Wednesday, Thursday, go into a consolidation before aggressively moving back. So again, traders think this is day 1 up. But what we're looking at is 3 days of squeezing down low into the bottom of the range. The same thing can occur on the upside. That's another type of example. We're going to go through a few examples on the charts in a minute. Sorry again about the mess. I need to get a new dry erase. The other scenario is that we just get a normal week where it goes up, goes into consolidate stop hunts low, goes up, hits the stops low again, and then on level 3 breaks out of the range in the direction of the trend to give us our 1, 2, 3 somewhere up here, and possibly an M pattern before going into consolidation and going back in the other direction. Now that one is easier to identify because typically we'll see the Asian consolidations sit on top of each other. So if we go back to our discussion previously about the average daily range, depending on which pair you're following, and just to reiterate, I follow the 6 major GBP crosses. One of the main reasons is that these pairs usually will all produce at least 1 or 2 or more really strong 50 pip trades each day. Now, again, that may not fit our perfect criteria, but the pound moves consistently. Other pairs, other major pairs, I find only move 25 pips roughly on average. Now there may be a move towards the end of the week that moves more, or 50 pips, or a 3-week pattern that builds up and we get a strong move, but I'm talking about each day. These pairs move very consistently, 50 pips, and if you've been following me, you know this 12 candle rule applies. You know that they move off the 0s and 50s. You know that the best moves occur once the market opens, and a lot of those moves come off of highs or lows of the week, or within the daily range from the previous day's high or low, or within the Asian box itself. So if you're risking 15, 18 pips on a major pair and it's only moving 25 to 30 pips, that to me is you've got to have a high hit rate. Whereas on these pairs, if you can master this and you start positioning yourself 18, 15 pip stops, and these markets are moving 50 pips or more, especially if they're in a trend, then that's where you can really skew your average rate of return on your risk. So coming back to our conversation about peak formations and 3 levels of rise and drop, one of the things that you'll see on the bottoms and tops of daily candles often, or on the ends of, if you look at your 15-minute charts, at the high and the low of previous days, you'll often find pins on the top. So one of the things that you can start to look towards, if you have Asia, then London comes on board, for example, and as we talked about, the Europe changeover breaks out and you're at the high of the week. This is typically the sort of pattern we're looking for, is that London will stop hunt back. It'll open up outside of the range, stop hunt back into the Asian range, and continue below, and either consolidate underneath of that low, pull back, retest, and then move down in towards the US session, at which point it may, there's something we're going to talk about in one of the next few videos. It's the 7 o'clock stop hunt. Very important. Again, timings. Most important thing I think out of all of this is numbers and timings. If you can understand the importance of timings, then this 12 candle rule and the 1 hour phenomena that we talked about will start to really make sense to you. So the market may come down, stop hunt up, move down into the US Open, and then move back in and consolidate for our close. So there we have our open, our stop hunt, our trend, our pullback, and our consolidation, and there's our daily chart for our high, low, open, and close. And again, when you're looking at your 15-minute chart in your Asian range, I talked about identifying the 25 pip box. Start thinking about when the market goes back into consolidation, do we see a stop hunt? Does it go back into consolidation, into the beginning of the Europe changeover, or as if this is the Europe Open London changeover, do we have a trend move? As we head into the US market open, do we get another stop hunt and then back into consolidation. This 25 pip consolidation can give us a lot of information, especially if we're paying attention to which way the breakout is. Now, if we're in a weekly cycle, and this is the high of the week and this is the low of the week, the next day, if we open up and go inside here, we're in the middle, okay? We don't want to be working from the middle. We can only work from the very extremes of this day. And the reason why that is because the market has buying down here and selling up here. And if you're trying to trade up in here, you're buying high or you're selling low within this range. It's most important, if you're going to be targeting back to this anchor point, that you sell high for the move back down, or you buy low for the move back up. And again, we talked about 25 and 50 pip increments outside of this range as our double zeros and 50s, okay, as potential major areas for the institutional buying and selling. We're going to go through a few examples of what I'm talking about, but mainly, again, we're going to go back. I'm going to encourage you to go back and look at your weekly charts on the 15 minutes Monday to Friday and start identifying what the peak formations looked like, and then also if you can see 3 levels of rise or drop within that weekly cycle. Let's take a look at some examples now.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburktrading.com. I create updates on almost a daily basis and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined and may the markets go with you.